All right, so now we know how much we have to purchase. In April, we're purchasing 637. In May, we're purchasing 754. In June, we're purchasing 460 for a total of $1,851,000 during the quarter. Now, just like our customers pay us late, we also get to pay our suppliers late. And so we have a policy of paying our suppliers for our inventory at particular times. So our policy or our expectation is that 35% of what we buy will be paid for in the month we buy it, and 65% of what we buy will be paid for in the month after we buy it. So in the meantime, when we've only paid for 35% and 65% is yet to be paid, we have what's called accounts payable. And again, you should remember that from your introductory financial accounting class. Accounts payable is the amount of money that we owe suppliers for things we've purchased but have not yet paid for. It's the flip side or the mirror image of accounts receivable. So our accounts payable, our supplier considers that same money accounts receivable because they plan to receive that money. So we need to worry about this, or we need to understand this when we create our schedule of expected cash disbursements for merchandise purchases. Now, of course, in real life, there are going to be lots of expenses that are paid on some kind of a schedule. Not all of your expenses will be paid in cash except merchandise purchases. What we're doing with this example is we're showing some expenses that are paid across time and other expenses that are paid in cash. We'll see those later. So we're just trying to give an example of how we show both of these things in a budget. So how much are we going to pay for during April, May, and June? Similarly, with what we did for cash collections, we can do this for our merchandise payments. We're going to pay 35% in the month of purchase and 65% in the month following purchase. So in April, we're going to pay 35% of April's purchases. Notice we're not paying 35% of April's cost of goods sold, but we're paying for what we purchase. Our suppliers want to get paid for what we buy from them. Our suppliers don't care whether we sell it or not. Our suppliers care that we've bought it from them, and the amount that we bought from them is what we have to pay for. So that's what we're doing. We're making sure that we're paying for 35% of what we pay for. And so we can drag this across to our 3 months, and we can see that in May, we're paying for 35% of what we buy in May, and in June, we're paying 35% of what we buy in June. We also know that in April, we have to pay for 65% of what we bought in March. And again, we can look at our accounts payable, and we can say that as of March 31st, we owed our suppliers $248,950. Sorry with it. $248,950 is what we owed our suppliers at the end of March and have not yet paid for. In May, we're going to pay 65% of what we buy during April. And in June, we're going to pay 65% of what we buy during May. So in each of these months, we're paying 35% of the current month, and we're looking back 1 month to figure out the 65% portion. And we can simply add those two up to determine how much cash we're going to pay our suppliers for inventory purchases in each month. For the quarter, because we don't have any beginning or ending balances to worry about, we can simply add things up. And we can figure out how much we're going to pay in the quarter. One more thing to think about, we know that in June, by the end of June, we'll have only paid 35% of June purchases, and the remaining 65% of what we bought in June is going to have to be paid in July. And so this will be our June 30th accounts payable. Again, we'll need that number when we create our June 30th balance sheet. So what we have here is our cash payments for merchandise disbursements, or sorry, cash disbursements for merchandise purchases. One thing to bear in mind here, as we look at our inventory that we buy, we sort of have three different numbers that are similar but different, and we have to keep these concepts straight in our heads. The first thing we encountered is the cost of goods sold, and it sounds kind of simple, but cost of goods sold is the cost of the goods that we have sold. So when we sell it, it becomes cost of goods sold. So that's one concept we have. Before we sell it, we have to buy it. So the amount we buy and the amount we sell are not always going to be the same in a particular period because we buy it before we sell it, and part of why we buy stuff is to plan ahead for the next period. And part of the amount we buy is because in the last period we planned ahead for this period. So we always have a timing difference in how much we're buying versus how much we're selling in a month. And so these numbers are going to be different. Cost of goods sold is the cost of the goods that we actually deliver to customers. Purchases is the amount that we buy. And then because we don't pay for stuff in the same time we purchase it, we also have cash disbursements for merchandise purchases. That's a third category. These are similar, they're related, they all relate to the inventory that we buy and resell, but we need to recognize that these are slightly different aspects of that inventory. How much is sold, how much is purchased, and how much we pay for it. So we do need to keep those similar characteristics or those similar numbers straight in our head.